Morning, Market Chameleons, and my favorite chameleon, Dimitri Pargamonic. How you doing, Dima?
Good morning, Will. How are you?
Great. I'll pop the disclaimer up. We can get to that.
Yep. So good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's a disclaimer, everyone, and with that, we'll get started.
Yeah, I have to apologize, Dee. I've got a little guest in my office, which is the lower level of my barn on the property. A cricket has entered the house, so I'll try to mute it so it's not too annoying, but you can probably hear there's a cricket in the background somewhere.
Yeah, cricket's very vocal today. What we'll do today, Will, again, is just do Q&A, customer question and answer. The way it works is you could ask questions, any questions you could put in the live chat. Will is monitoring them. He'll read them off to me, or a better way to do it is Will is providing a link that you could click on in that chat. If you click on that link, it takes you over to Zoom. When you're in the Zoom meeting, you could raise your hand. This indicates to Will that you're willing to turn on your audio so we could hear the question. You don't have to turn on your video, but we'll be able to hear the question. This is, I think, a better way to ask, because then you could point us to the direction where you're looking at. We could ask you about any of the surrounding circumstances. So you have those two abilities, and the idea behind the Q&A is you could ask questions about Market Chameleon tools, maybe statistics you've been seeing, maybe something that you've experienced through trading that you weren't expecting, or something unusual that you see. You could share that with the rest of the community, because it will benefit other people, because the best way to become a more successful trader, it's experience and it's learning, right? So experience and learning trumps everything. Maybe other people ran into the same situation, or they haven't ran into that situation yet, but at least they'll benefit from hearing, your experience. So what we'll do is while we're waiting for some questions, I think we had some yesterday already queued up that we didn't get to. So we'll take those people first if you come back. But while we're waiting for it, we're in a little bit of delay. What I'll do is I'll start on the pre-market report, see what's moving in pre-market hours. Then if we're not getting any questions, I'm going to default to some of the questions that we've had before through either email, chat, or other shows that I wrote down, and we could start on those as we're waiting for the questions to queue up.
Yeah, so I put in the queue the link to the Zoom. I know Albert had a question yesterday, which was good. I don't know if you want to come on over, Albert, and ask that question. I also see Jake is in the Zoom. I think he may have had a question, but if anyone, just come on over and let me know, either with a hand up or with a little note in the chat that you're ready to talk, and I will let Dee know. And also with Jake there, and you mentioned communicating with other chameleons about, what you've done in the past and different ideas. Jake runs a Discord group that a lot of chameleons are a part of. So if you want a link to that Discord, just email me, williammcbride@gmail.com. I will also put that in the chat. And there you go, Dee.
All right, great. So let's first get started. I'm going to share my screen. We're going to take a look at the pre-market report. And these are stocks that are moving in a pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. Coming down here really quickly, I see 55 made the percentage gainers list, 68 on the percentage decliners list. So from that perspective, slightly negative bias at the open, but almost mixed. So it's not a very heavily weighted one, to one side. Let's take a look at the higher market cap stocks, see if we see a similar situation there. So I use that market cap filter to look for stocks 20 billion or higher. Here we see 7 made the percentage gainers list, 29 on the percentage decliners list. So from that perspective, looks like, slightly bearish bias at the open, but these lists not very big, but nevertheless a little bit more bearish than bullish from market breadth perspective. I see a couple of them just reported earnings with Lulu. That's up 12.3%. Not a lot of volume in the other stocks. So if we don't have, or while we're waiting for the questions to come up, Will, let me know if you see any. I'll just start on some of my other questions that I wrote down. I think you're on mute, Will.
Sorry, D. Damn cricket. I did mute myself and I was typing into the chat. Albert is going to come on. He just hasn't come over yet. Oh, here he is. So Albert just came over and we're going to go live to Albert. Is that okay, D?
Yeah, that's, yep.
All right, here we go. Albert's coming in, a regular Albert. Hey, Albert, thanks for coming over, my friend.
Yep. Hey, Albert, can you hear
us? Good morning, guys.
Good morning. How are you?
Pretty good, pretty good. You guys?
I'm better knowing that you're on now, Albert. Thanks so much for coming over.
Thank you. You guys are too kind. Let me just take out the volume here on my side because I got the web and the Zoom at the same time on the volume.
Sure, no problem.
I gotta turn one of them off. Sorry about that.
Hey, Albert, can you hear us? Good morning, guys. Good morning. How are you?
Pretty good, pretty good. Okay, I turned off the volume.
Okay.
Yes, so my question from yesterday, I guess.
Yep.
Yeah. Okay. The question had to do with the spread. Why would someone choose in the money versus out of the money legs when constructing a vertical spread? My observations are that besides the risk assessment, the risk of assignment, besides the risk of assignment when choosing in the money legs, you get a reward risk ratio of greater than 1, while out of the money legs, you don't have the risk of assignment, but your risk reward ratio is less than 1.
Okay. And you're looking at a call spread or a put spread?
Either one. We can go with a call spread.
Okay. So let's go. I'm gonna kind of just go to the options chain so people get a visual of what we're talking about. Okay. So
I'm actually using your example from the top trading ideas. I think that preliminary window that I think Jake in Indonesia or Malaysia uses.
Okay.
This morning
you're talking about like AMD. Over here. Like these?
Yes, exactly. I forgot what the name of that window is specifically.
Okay, so this is just the home page. So let's take a look at what we'll do is we'll kind of go to AMD because I have to set up both types of scenarios for you. Okay, so here's AMD. All right, I'm going to go to the options chain because you're asking, you know.
Yes, if we go back to the screen, you'll know exactly what your viewers mean or what I'm trying to express. The screen that you were just in, where we saw AMD and you had your analysis.
Right. So you know, the analysis is only looking at one put spread that it detected based on certain conditions that we put in the screener, right? So it was looking for something that, you know, has a you know, good. It's looking at, first of all, a lot of stuff, you know, like historical stock behavior. It's looking at different combinations of spreads, looking where there's a theoretical edge. Then it's looking at where do you get the best return if the stock is flat. And so there's a lot of stuff going on there that doesn't actually deal directly with your question. So to answer your question of why it's in the money or out of the money, I would have to set them both up to answer your question. Okay. So remember there.
Which, by the way, I love that startup screen with those lists. I think it's great for generating ideas.
Yep.
It's a starting point. Obviously, it's a piece of the puzzle. You got to do your homework anyways. But I think it's a great starter to for those who are saying, well, what do I trade today? What no? So anyways,
thank you. But to kind of to go over why are you doing an out of the money put spread versus an in the money put spread, right? That's kind of like what your question was, right?
Yes.
Why
What,
choose?
what would be
Why
the,
choose?
what would be the reasoning, the logic, the process?
Right.
So should I go with in the money, out of the money? Because
Right. And
from a numbers, the reason I came up with this question is because, like, when I look at your top trading ideas, and like this morning AMD, it says like you sell the 103 and you buy the 10, sorry, you sell the 106 and you buy the 103, and there's a 76.5% chance of you're basically you're making $1.30 and you're risking $1.70. So you come up with a 76.5.
so you're looking at October 8th expiration here in AMD, saying
Yes.
selling the 106 put, buying the 103 put for $1.30, right?
Exactly.
So it's a third. So you could see it's a $3 put spread, right? You sell 106, but so if the stock crashes below 103, so it goes to whatever 102, 100, 50, 0, doesn't matter. Once it goes below 103 at expiration, you're buying this back for $3, right? Because you have to buy that put spread difference between the strikes. But since you received $1.30, right? Since you received $1.30 and you buy back for $3, you're losing $1.70, right? Because you even though you're buying it for $3, you did receive $1.30, so you're paying $1.70. So based on your risk
point of view, sorry if I'm interjecting. From a quantitative point of view, I like to look at risk reward, or the opposite, reward with risk. And when I look at the 130 for 170, what it's basically telling me is that I'm risking $1.70 to make $1.30. Which is less than 1. We want to do the opposite. We want to risk $1 to make 2. So in other words, so if we wanted 2 for 1, we'd want to make 340, risk 170 to make $3.40, and there you get your 2 for 1. But here it's the opposite. We're risking $1.70 to make $1.30, which is less than 1. So my question is, why would we want to risk more than we're making on a risk reward basis?
So the part that you're missing here, the part of the equation you're missing here, is the probability of making $1.30 versus the probability of losing.
I agree with you.
So in your scenario that you painted, what you're saying is, if the probability is exactly the same, then yes, you were right. Then you would rather make more and risk less. But if your probabilities are different, then you got to take that into account. So like, for example, if I'm playing the lottery ticket, my risk is $1 to make, whatever, $100 million. That's a great risk reward. But the probability of me making that $100 million is like, I don't know, billion to whatever it is, right? So it's, what is the probability of you making that $100 million? And what is the present value based on the probability that that ticket might not be worth $1? It might be worth a fraction of a penny, right? So the idea when you're saying, when you're just looking at these two numbers, right? What you're not taking account is, well, where's the stock? Where are the strikes away from the stock? And what are the probabilities? And we don't know exact probabilities. We could just estimate it based on how the stock moved historically, right? But in this situation, this is an out of the money put spread. So this is, we're looking at it right now, right? The stock is 106.13. So in this situation, if today was expiration, right? If today was expiration and the stock's above 106, both of these puts would expire worthless and you would have kept $1.30. So the idea there is that, well, you don't really need the stock to go up. You just don't want it to go down, or not down by below 106 by more than this amount, right? So you don't really need the stock to even rise by a great amount for this trade to become profitable at expiration. Now, that would be different if you had an in-the-money put spread. You need it to go up or you will lose money if the stock just sits there. And that's when it comes in why the ratios, right, they're proportional to the probabilities of these being, profitable at expiration. Okay, so yes, you could find something where, maybe, these are reversed, right? But for you to actually keep that credit that you collected, the stock has to do something, right? The stock has to go up by a certain amount. And then what you're doing is introducing, that there's maybe a less chance or less probability of that happening. Okay, so when you're selling a put spread, be careful. When you're selling in the money put spread, that credit that you receive, right? That credit that you receive is not a profit, right? This is not a profit, the credit you receive. You just got kind of paid, right? Because somebody else took on, because you transferred risk. You're holding risk to expiration. So you don't get to keep that. It's not like that's a profit. Yeah, you receive credit, but
because of the risk of assignment.
Depending on the account, right? Depending on the outcome, you may end up still losing money on that trade. Okay, and in the money put spread, if the stock sits there, right? Like, so what does an in the money mean? Let's assume that this stock, AMD, was not 106.13, it's 100, right? So it's already below both strikes. So if it's below both strikes, if it's at 100, right? That's the in the money. Now we reversed it. And you sold this for $1.30. If the stock just sat at 100, if all it did was just sit at 100, it's closed exactly the same price, then you'd have to buy this spread back for $3. You see? So it's the reverse. Instead of when the stock's unchanged above 106, you keep the 130. But if it starts at 100 and it's unchanged, you lose $1.70.
Yes.
Okay. That means it has to go from 100, all the way through those strikes for it to be profitable. So now you have to have it, increase by 6%. Here, you don't really need it to increase. You just need it to basically either stay the same, or increase from there. All right. It can decrease a little bit, right? Now you have a little bit of cushion there because it's already above the strikes. So you have a little bit of cushion there, it could go below 106 by $1.30. And
so if I understand what you're saying is it's a balancing act. If you have a reward risk ratio less than 1, like in this case, 0.765, because that's what the 76.5% mean.
Right.
You need a higher POP, probability of profit, that is greater than the 76.5.
Yeah, like think of it as right. Like what is the probability? What is the probability of it, making this amount? Just like a lottery ticket. What is the probability of it? What is the probability of you winning that lottery ticket times the reward, right? How much would you make? And then you get that present value. So if you're paying it above the present value, it's like in the long term, you're going to lose, right? So when you're talking about risk reward, a lottery ticket's $1. You're not risking a lot. You could make $100 million, but your odds are so low that it's not even worth $1, right? Because the odds of you winning that lottery are just very, very low. So you got to kind of look at it from that perspective. That's the piece I think that you need to consider when you're doing it. And that's why when we're filtering it out, that's what's happening in the background. It's taking those historical return distributions, calculating historical probabilities, right? And coming up where we think there's a theoretical edge. So for example, down here, where are we here? So right here, right? We're selling it for $1.30, but what do we think it's worth? Well, based on the historical stock behavior, right? Based on the historical stock behavior and how the stock tended to move over the same period of time, given the same circumstances, on average, it was worth 94 cents. So what we're saying here is that, well, on average, if it's worth 94 cents and we use the historical odds because we don't have anything better, if we use historical odds, we're selling it for actually a better price than historically it's worth. So that's kind of the theoretical edge. Okay. And
I understand. Your fellow chameleons asked a good question, which is this theoretical edge based on holding till expiration? If I understood the question
exactly
correctly.
It's always holding to expiration. So remember, whenever you price an option, it's always priced to expiration. Okay, there's no such thing as pricing an option, 1 day before or 2 days. You're always pricing an option based on what is it worth? Well, it's worth based on holding it from now to expiration. So yes, it's always.
While you're on that thought, Albert was nice enough to ask a question that someone else in the chat, I think maybe it was Rob, asked. Someone else asked, is there a way when the person's looking at that front page and everything's priced to expiration and all the data is to expiration. So he was asking, when's the time to take it off? I don't know if you can speak to that.
Right. So really there's no one answer to that because it's all based on the surrounding circumstances. So at every single point in time, you're looking at all the different factors, right? That come into play. Should I take it off? Should I hold it? Did the circumstances change? Is it, do I find different opportunities that are better? So there's too many variables to say when there's no answer to that, right? It's not like you could say, this is the right time. This is the right time to take it off. This is
If I can add my 2 cents to help that fellow chameleon, I've kind of followed the tasty trade mantra of 21 days before gamma becomes a risk factor.
Wait, what is that? Can you repeat that, Albert?
I tend to follow the tasty trade mantra of closing trades or rolling them at 21 days to DTE, days to expiration, to avoid gamma risk.
Okay, I mean, I'm not sure exactly what that means, but if it's working.
It means that you close the trade because as you get closer to expiration, theta gamma becomes a bigger risk. The speed at which delta increases or decreases. So if you hold on to, it's much more sensitive. Yes, on the credit, theta will increase because if your credit, your positive theta, meaning you collect more, the bulk of the decay of your credit, you'll get it underneath 21 days, but that is being counterbalanced or like risk. That's your gimme, so to speak. That's your reward, but your risk is gamma. Gamma can wipe that out very quickly, especially as in the last week of expiration. Some people like to play it. Some gambling types like to play weekly. You pump up stocks earlier in the week so that they can play that gamma squeeze, but it can go against them. So in generally, that's what gamma risk is. It's the speed at which delta accelerates. It's the second derivative Greek.
Okay, so it sounds to me that your strategy is kind of looking at longer term options and rolling out of them
monthly,
45 days, right? And then basically as it gets closer to expiration, you roll out of them and go back into longer dated options.
Yes, to collect additional premium.
Okay.
This is, I think what Albert's saying is that this is how Tasty trade, their community, this is what they're this is the,
This
the
this is
style
how
that they
they
trade, basically.
this is how they recommend. Right. Okay.
Just trying to help your fellow chameleon add,
Yeah.
add my 2 cents to his question. Well, when do you get out of the trade? Before
Albert,
gamma becomes a risk?
there's no wrong strategy, as far as options. It's everyone's experience and how they trade and,
Yeah.
how they want to touch the market, right?
It's
But
from
we've heard
experience.
from other, sorry, Dave, what were you saying?
No, go ahead. Well, yeah.
Oh, I was just saying we've heard from, the Tasty traders are a great group and they have, a way that they like to position themselves and trade in the markets. And it's great to hear that this is working for you. And, you've adapted that for your trading style, which is awesome.
Yeah.
Yes, I agree. I'm not trying to profess there's as many ways and strategies of trading as there's traders, and whatever works for you, you go for it. No.
Yeah. Yeah. So, and is that it's a lot of times, well, most of the time, your strategy, right? I don't think there's a right or wrong strategy, because I know people who are very successful buying options and very successful selling options, and they've learned how to do it, when to do it, what to look out for. The thing is it's going to fit your personality, right? So there are people who cannot stomach being short options. They're just like, I have to be long options, and the risk rewards are better. I don't want to, have an unlimited risk. And then there are other people who cannot stomach being long options, because they're like, I don't want to be long decay and, have to wait for something to happen. So it will depend also on a person's personality, which is fine. Look, and I'll tell you that I've people who only want to trade earnings. They just that's all. I don't want to deal with, I just want that one day. That's all. I analyze that one day, the earnings. I look for something in specific, something that if something lines up the way I like it, then I do it. If it not, I don't do it. But I only like to trade earnings, because everything else, there's market risks, all that. Other people tell me I want to filter out and not trade anything around earnings. Like, if there's earnings, I don't even want that on the board. So until it's gone. So it depends on the person's personality. You get into a strategy that you feel comfortable, that you know how to manage the risk, and you've seen and experienced something that you already are looking for, specific setups where you feel comfortable about that risk and reward, that you've already seen it working. You're comfortable with managing the risk, you're comfortable with the trade, you're already comfortable with all the different exceptions that happen over time. You tweaked it, and that's kind of what happens. And over time, you might develop more and more strategies, but kind of what you're telling me, Albert, you're going to the longer dated options.
Monthly.
I talk to people who are comfortable with that.
Well, I think it's not longer dated, D. I think it's specifically 45. Their model is 45 days out, so it's monthlies at the start of the expiration when it shows up on the board, basically, and try to take it off 21 days. Is that correct,
Right.
Albert?
Yes, like 21 days is like a guide there,
Right.
but sometimes I'll hope it can be no. And one of your chameleons posted on the chat says, well, it doesn't have to be 21 days. No, if you have a profit target of 50% return on the premium, if you collected 50%, well, you take it. No, if it happens within 2 days, you take it. If it took 18, you take it. But you have to be aware that around 21 days, gamma starts being a factor, and you can see your P&L. No, you're maybe 75% of your total premium, and because of a little move in the underlying and the gamma is just going to make it go down to zero or even negative. So you can lose. And if you're on 1 day to expiration, you can go from 0 delta to 100 delta, and then your gamma, because of gamma, and there you go from being positive to losing it all in the blink of an eye.
Right. And why I think I tend to agree with the longer dated options, especially for, maybe the style that we're talking about, is the further you go out in time, you have to assume that you have a disadvantage in the shorter term because you don't have as much information as some of these other institutions, right? That you're trading against. So they may have superior knowledge and information in the very short term that you don't see, that a certain market might be priced in a way for a reason, and you just don't have that information. But as you go out further and further and further in time, that informational edge, that informational disadvantage diminishes. Over longer and longer period of time, it's harder to tell what's going to happen out further and further to the future. So I would say that I probably agree with that. If you're going out further, maybe especially past 21 days, if you're going out there, that informational disadvantage, it's more minimized. It's not as bad as if you're doing the weeklies. Okay, so I think that I would probably agree. Huh?
So the in the money versus out of the money is a balancing act between your risk reward and the profit and the probability of profit.
Yeah, exactly. Because that's what you want to see. Like, whereas, like, what is my probability of profiting? Making that profit, right? So and if you could calculate that, then you could figure out, well, what is the expected value of this option, right? Then you could kind of see, well, if the expected value is this and I could get this, you kind of get a sense of like, where's your theoretical edge, right? How far away is it from a benchmark? You can make a little bit more informed decisions. Other things might be going into play there. So you still want to see the surrounding circumstances, but at least you have kind of like a benchmark to start off with, right? And then you kind of do your analysis from there.
Yeah, I kind of do that already. So if I'm risking $1 to make 50 cents, then I know I have to have at least a probability of profit of 2 to 1 or 33%. So if I'm at 50% chance of making money, then it's okay to risk $1 to make 50 cents because you have a positive edge of 50% minus your 33.5, which is 17%.
Okay, I mean, there are a lot of numbers there I didn't quite follow, but as long as if that's what you're doing and you think that you got a positive expected return, that's the idea, right? If you're playing a statistical edge game, that you want a positive expected return.
So why don't we leave it at that? Because the freight train just rolled over, everyone. We're 3 minutes into the trading day.
Oh.
The bell went off. Albert, you bring it. I mean, I'm thinking we may have a monthly show with you, Albert, you and I.
Yeah.
You're really spectacular. Are you on the Discord, Albert? Just FYI.
Yes, I'm in it, but to be honest with you, I'm not very active because it moves fast. And sometimes I'm focused on my trades. So I don't really have time to kind of read every single one, but I do go through over it at the end of the day to see if I pick up little snippets of valuable information and continue my learning.
Well, it's just great in the chat. There's so many discussions going on, and the fact that someone created, and that someone is Jake, the doctor, and Raj were really the creators of it. It's a great where people can go and discuss their different trading styles because everyone's a little different. I mean, there was a good discussion about Albert's, 45-day, 21-day in the YouTube chat. So anyone who wants a link to that Discord, it's email me, williammcbride@gmail.com. Jake, thanks for joining today. Albert, thanks for bringing it. We have William, who's a new user who has his hand raised for the entire half hour, D. So we'll try to get to him tomorrow. And we had a bunch of questions on the YouTube chat that I've taken down, and I will send them to D. And everyone try to join tomorrow. We'll get more questions. Is that good, D? Yep. Thanks, Albert.
Yep. Sounds
Thank
excellent.
You guys.
Thank
really
you, Albert.
Appreciate it. Do you have the link for the voting? Because I go to every day. So
you could put the link in there, Will.
Yeah, no, I'll pop the link in. Thanks for mentioning that, Albert. And Chameleons, you're all, we're very thankful for the support you've shown.
I
everything.
just saw it. Okay, I just saw
Yeah,
it.
appreciate it. Awesome job, Dima. Thanks so much, buddy.
Thanks, Albert. Thanks, everyone, for joining. Hope to see you guys tomorrow. Stay safe out there. Have a good trading day.